All right, as we round out 2020 and taking a look at the markets and the incredible rebound that we have seen since the March 23rd lows, S&P up by 13.6%. All eyes are, of course, on the remaining weeks of 2020 and whether or not we've got a grind higher and a Santa Claus rally, but perhaps more importantly, what 2021 looks like. A number of companies, investment banks that is, are out with their outlook, their 2021 outlook. Let's get Canaccord's view right now for that. Martin Roberge is joining us. He's the Managing Director of North American Portfolio Strategy at Canaccord Genuity. Martin, nice to be able to catch up with you and get your views on 2021. Yeah. Give us your sense in terms of your expectations.
Yeah, it's a couple of themes, but I would say probably the first out of consensus call that we have is that commodities will beat, as an asset class, will beat stocks and bonds. And if investors follow the following themes, non-U.S. over U.S. stocks, small over large, cyclical stocks over defensive stocks, we believe that they will do probably more than the 5-7% returns that we expect for the large cap indexes.
And Martin, part of your call, you're saying that non-U.S. stocks will lead, that the commodities will lead, and that is really based on China. This is going to be a China-led recovery. That's important. You know, we've been watching, and I've been talking about this now for months in terms of the incredible rebound that their economy has had. Every data point we get seems to be telling us that they're doing quite well, and that seems to be your call as well.
Yeah, but the thing about commodities is not only China. First of all, I don't expect China to slow down before the October, the Chinese Communist Party celebration. So I don't think that they will slow down that much when it comes to reflating or supporting the economy. But you have to remember also that there are three other things that make it more than just a China story. First of all is that this is a goods-driven recovery, as you know, because of the lockdowns. Services are not really participating, so consumption is mostly on consumer goods, and that requires a lot of commodities. Secondly, if you look back historically, or at least the last cycle, 2010, like 1 year after the recovery, you had the Greek crisis, the sovereign debt crisis. So the U.S. dollar was well bid, like putting a cap on commodities. Not this time around. Okay, and lastly, if you look at the consumption of goods has been so strong in Q2 and Q3 this year that we are going to go through a major inventory restocking cycle around the world, not only in Canada and the U.S., but around the world. And obviously, this is positive for commodities.
Martin, you mentioned the weakness in the U.S. dollar there. Catherine had a conversation earlier in the show, and the call from the guest was, this isn't temporary weakness. This is part of a longer pattern that will see the U.S. dollar continue to weaken, is no longer viewed as the reserve currency. Is that too bold of a call at this point in the U.S. dollar?
No, this is the right view. Actually, in July earlier this year, we broke the uptrend that began in 2011. So we broke the primary trend was broken. And the last time we saw this breakdown was in 2002, late 2002. And we had a multi-year of U.S. dollar weakness, multi-year of commodity outperformance. And there are three factors driving this U.S. dollar down. Like the twin deficits, it's going to bottom only probably in 2023. Real rates in the U.S. are the lowest, among the lowest in the world. Okay, they are extremely negative. Okay, that's number two. And you've got this global growth recovery, which we don't see peaking before maybe 2022, when we start to see maybe some rate hikes. But so there's at least like another year or two of visibility on U.S. dollar weakness, and it's not just against the euro. It's again against the emerging market currencies as well. We have to remember that because these countries are like net importers of commodities.
Longer term, I mean, obviously, all of those catalysts make sense for U.S. dollar weakness. But has the United States, has their currency lost that perch? I mean, will they get it back after a couple of years, or is the sun setting on the U.S. dollar reserve dominance?
No, it's down. It's down from here. What we're witnessing with Asia or China basically announcing last week or 2 weeks ago, you correct me if I'm wrong, the Asian Pacific trade deal, where they are going to be, like Japan is part of the deal, Taiwan, Thailand. These guys are essentially creating one single block, and there will be incorporating Europe within that block. And this is going to be 70% of global trade. So the U.S. will find itself isolated or captured with Canada and Latin America. And that's a small portion of global trade. So especially like now that we've got news that maybe President Trump wants to return in 2024, but these guys are not walking back. They are creating Eurasia, and Eurasia will probably strengthen the Asian and European currencies relative to the U.S. dollar. So this is a structural bear market. And I would urge investors not to try timing the bottom of that cyclical decline. It should persist for a few years.
Yeah, Martin, I remember it so vividly going back to, I guess it was that 2002 time frame, or I actually thought it was a little bit later. I was at Deutsche Bank at the time when there was a structural decline in the U.S. dollar, and those trends tend to last in terms of currency moves 7 to 10 years. So you're right in terms of like, don't try to fight it if it's a structural move occurring. Let's bring it home, though, to Canadian investors a little bit more so. You know, you're saying invest overseas, not U.S. in terms of your weighting. But what else can you tell us about, you know, investing in Canada right now, which way you might want to be tilted, what you want to avoid?
Yeah. First of all, there's no need to go and capture high dividend yielders outside Canada. We have plenty of them, okay? We don't have to go out there and pay withholding taxes on foreign high dividend yielders. So we can stay home for those looking for income. For cyclicality, or like the commodity stocks, well, we've got some here in Canada, but those are kind of small mid-cap stocks. So you have to go probably elsewhere. You have some, obviously, in EFI regions, and some in emerging markets, and some in Australia, and some in the U.S. as well, especially when it comes to energy. Okay, we've got some big, large cap energy companies, integrated companies in the U.S. So I think you need to diversify across regions when it comes to your cyclicality of your portfolio. But when it comes to the income, like, stay home. Another point, very important, we never look, Catherine, at how does Canada compare relative to EMs or relative to EFIs. What are the drivers of relative outperformance? And it's the U.S. dollar. Historically, when the U.S. dollar goes down, EMs and EFI equities will do better than Canada. And when the U.S. dollar goes up, it's the opposite. Canada does better than EMs and EFI. So if we have a negative view on the dollar, you've got to be more positive on EMs and EFI, especially when we account for the corporate debt. Lots of debt in Canada, in corporate Canada, very little debt on the balance sheet of international equities or international companies.
Interesting. Martin, it's so amazing, too, because just when we're starting to see a bit of a catch-up trade in some areas of the TSX, you're telling us be a little bit more careful in terms of relative performance.
Yeah.
Yeah. Okay. Great to have you on.
Relative
Thank
to
you.
U.S. and relative to international stocks.
Yeah, exactly. All right, Martin, great to have you on. Thank you so much for your 2021 outlook. Appreciate it.
All right. Bye-bye.
Okay, thank you so much. That's Martin Roberge, Managing Director, North American Portfolio Strategy at Canaccord Genuity.